I'm Rhonda Legge with ETF Guide. I've got some charts, performance, and investment reminders I want to share with you, so let's get right to it. Beginning with the 2023 performance chart. If you've been like Rip Van Winkle and asleep for 20 years and you're just waking up, well, here's your update. You see that Bitcoin has been the runaway winner in 2023, gaining almost 170%. And everything else, you see those other ETFs linked to stocks, S&P 500, as well as commodities and global real estate and bonds, way down there toward the bottom. Nevertheless, the best performer of this group besides Bitcoin has been S&P 500, SPY, ahead by just over 21.5%. Now, those of you saying, well, you know, I should have listened to Michael Saylor and just put all my money into Bitcoin. Well, let me remind you the 2022 chart and how that looked. Bitcoin was down 64%. So no, you shouldn't be putting all your money in Bitcoin, no matter what all these crypto bulls say. And you can see the logic and the sanity of having a diversified approach. We just never know year to year which of these specific asset classes are going to be top performers. And so if we have a nicely diversified portfolio with different types of asset classes, then the end goal is a happy result and a smoothing out of your overall performance. You can also see in 2022 some of those laggards that really stunk it up besides Bitcoin, U.S. stocks, as well as global real estate, and even bonds. I want to talk about bonds in a second, but commodities, a very underrepresented asset class in most portfolios. SDCI is a great ETF in terms of a core commodities exposure. And if your portfolio is missing that particular major asset class, well, take a look at SDCI. But again, I want to highlight this particular chart, 2022 versus 2023, just to give you some context, because that's very important. Now, let's talk about bonds. And because I know I've been talking about it on this channel over the past several months, reminding you that bonds are not a safe haven as they're often sold as and promoted as, that, well, if stocks go down, bonds are going to protect you. Well, that has not been the case the past 3 years. Bonds are actually negative, ticker symbol BND, down almost about 11.5%. This is a bond ETF that's used in many, many portfolios as a core bond position. And bonds themselves are okay. They do have a place in a diversified portfolio, but they do not have any place as a safety haven or as a place that you should be using for your portfolio's margin of safety bucket. And you can see the 60-40 portfolio has also struggled. Only recently as it began to tick up into positive territory. So again, this is a very, very important reminder to those of you that are using bonds either in a 60-40 portfolio or just as a supplement to your overall equity portfolio as safety. Well, you're doing it wrong, because bonds definitely aren't necessarily safe, especially when interest rates have climbed as quickly as they have over the past 1 or 2 years. And so bonds may give you some protection. They don't give you full protection. It's important to remember that. And you can quote me on that. With investing, some protection is better than none, but full protection is always better than both. And so the margin of safety tool that I built at ETF Guide will help you to, first of all, calculate how much of your portfolio should be earmarked for safety, but then implement your portfolio's margin of safety, do it with the right tools and investments, and then, of course, monitor that portfolio's margin of safety. And of course, those are the 3 cornerstones that I teach you on this channel to have your money segregated in 3 buckets. You got your core and your non-core portfolio. That's pretty self-explanatory. Core owns core asset classes and ETFs linked to them. Non-core assets, things like individual stocks, venture capital, private equity, cryptocurrencies. These are all non-core asset classes, and they complement the core. And then your margin of safety is strictly reserved for assets that A, don't lose value, B, have zero volatility, and C, provide you liquidity. And each of these 3 buckets do something completely different than the other. So they complement each other. And so it's important to have a balanced approach And I think this can certainly help you with your portfolio construction and management. In terms of some other top performing ETFs, these are your leveraged ETFs, 3X daily leverage. The tech ETFs have been the runaway winners in 2023, TECL, as well as TQQQ. You got Soxel in there, that's semiconductors, and then, of course, TSLL, which aims for daily leverage to Tesla. All great performers, up well over 130%, up to 178%. These are 2023 performance gains. In terms of S&P 500 industry groups, those top three, XLY, XLC, and XLK, represent a big portion of the overall S&P 500, and they have been powering the broader S&P 500 ahead. That's why we see such great performance in the S&P 500 itself, is because of these three industry groups. And you take a look at those three bottom performers, those represent a very much, or what we would call a smaller portion of the overall S&P 500. They're important components, but they're not nearly as big of a portion of the overall S&P 500. And those underperformers, it's interesting to note they're in defensive industry sectors, typically associated with defense, consumer staples, and utilities. Now, our ETF Strategy Matrix, I've been sharing this with you on this channel over the past several months. And this really, the whole point here is to organize ETF investments and trades by their character or type. So you got the offensive, momentum-oriented trades, typically with ETFs trading near their 52-week highs. You got the defensive trades. These are maybe the ETFs that are defensive in nature. In other words, if traditional equities or traditional bonds are maybe neutral or choppy in nature, these are some ETFs to take a look at. In terms of your contrarian trades, these are clearly your out-of-favor trades, the ones that are the stinkers. They're probably trading near their 52-week low, and most investors have probably signed them off. And so these are some of the contrarian trades. ACEs, clean energy, all those ETFs have been killed. So that particular theme, by the way, of clean or renewable energy, I know some of you take offense when we call it clean energy, so excuse me. I'll call it renewable energy so we can stay friends. But that whole area, I think, is going to be gigundous. And if you don't have some exposure to that in your portfolio, I think you're missing out. No better time to do it when it's beaten up and out of favor. And then iDrive, same kind of theme, autonomous driving, electric vehicles. You can see all of that in that particular ETF. We did just do a ETF battle with top EV ETFs. iDrive was in that, so be sure to check that out if you missed it. And then income ETFs, income from dividends, as well as bond interest, as well as synthetic income. There's lots of ways to get income. I did not include any of the synthetic income ETFs on this list. SCHD, which has been out of favor, but focuses on dividend growers. And then PFLD, which is a hybrid, a mix of bonds and stocks, what's known as preferred securities. So check out that one and add it to your list. And then as far as an article that I wrote at Financial Advisor Magazine, following that same thought of bottom feeding some of 2023's worst performers, check it out. Check it out. I've got the link below. I think you'll like it. And then in terms of what you guys are thinking, what's on your mind, because I always like to find out on the community tab. I like to test you guys and also see what you're thinking. And so this was a question I asked you about ETFs and 401k plans. The question was, does your 401k offer ETF choices, and do you want ETFs inside your retirement plan? And I don't want to say shocked, but I was dismayed that an unacceptable 50% of the viewers surveyed on this particular survey at ETF Guide TV said this, that they do not have ETFs as a choice in their 401k plan. And so my question to you is, how do we change this? How do we make a difference? Well, this is how we make a difference. We add ETFs inside 401k plans. So if you're already investing in ETFs outside of your 401k plan, there is zero reason zilch reason why you shouldn't have ETFs available inside your 401k plan. We're helping you do that at ETF Guide. We just launched the ETFK retirement plan. ETFs plus 401k equals ETFK retirement plan. For those of you that are on the more analytical side, for those of you on the unanalytical side, ETFs and 401k plans, that's something we can all appreciate and understand. And so I've got a link below in the description section. If you are a CEO, if you run your own company or you're in touch with the human resources department at your company, send them that link and we'll get you a quote to ETFK retirement plans. This is the future of 401k plans, I promise you. In terms of other happenings, we don't really talk too much on this channel about politics. I try to stay out of that because I do take a politically neutral stance. However, I want you to understand what happens in politics and how it impacts everyone's financial bottom line. And this is a chart that actually shows a very interesting trend, a sudden string of congressional retirements happening. And this is, right now, we're at a peak. This is 13, according to Axios, U.S. members of Congress that have not sought re-election. We're up to 14 when we include Kevin McCarthy, a former House Speaker. And what I want you to understand are a couple things. First of all, why are all these politicians suddenly retiring from Congress? Well, I suppose one reason is because even politicians are sick of politicians. That's one reason. But I think it also speaks to the political instability of our times. And again, since I examine things from a financial perspective, I want you to do that too. I don't want you to get caught up in the politics, because if you do, then you'll miss the big picture. But the bottom line is that this congressional musical chairs is indicative of big financial problems down the road, big fiscal problems. We've been highlighting them on this channel. You see the U.S. government's credit rating was recently downgraded. And so the reason behind that is linked to this political instability, this inability up until now of Congress being able to operate in an effective manner. They've made no real efforts to curb runaway spending. They've made no real effort to deal with unsustainable $33 trillion of national debt. And then, of course, you got another $75 trillion on top of that tied to Medicare and Social Security obligations. So it's a very, very ominous trend. And no matter what anyone says, what I want you to remember, if there's one thing you remember out of all this, is that soaring U.S. income tax rates are the unavoidable end game. And so you better get your investment portfolio, you better get your retirement portfolio out of the way sooner rather than later. The way that you do that is by having proper tax positioning. And if your portfolio has good investment positioning, but poor or improper tax positioning, well, you're about to get run over by a freight train. And I don't want to see that happen. So again, I've got some reminders at the end of this video that are going to help you to do that. Roth IRA conversions, Roth IRA contributions, getting money into the tax-free zone is what will save you. Things like traditional IRA, traditional 401k plan do not protect you against higher taxes in the future. They defer taxes today, but they do not hedge you against dramatically higher tax rates that are coming here in the U.S. And so this is my public service announcement to all of you. On a final note, we're sad that Norman Lear, genius producer of so many wonderful television sitcoms. I remember some of these shows. You probably remember some of them. When I was growing up in the 70s, from All in the Family to Sanford and Son and the Jeffersons. I mean, just to have even one hit sitcom, that's pretty tremendous. But Norman Lear, I mean, this guy was a prolific genius. And some of these shows, I mean, these were just, I got to watch some of these reruns because they're just absolutely hilarious. And he passed away at the ripe age of 101 years old. And he will be missed, but not forgotten. And so that does it for today's episode. I got a couple final reminders. Add ETFs to your 401k plan. You can now do it with ETF Guide's ETFK retirement plan. Hit the description section below. We're going to help you. Also, tax loss harvesting, you got your deadline is December 29th. Better to do it now than wait to the last minute. Same thing goes for 2023 Roth IRA conversions. Your window is almost closed. Your custodian probably is going to give you probably another week to get this done. If you're going to wait until the last minute, then it's not going to happen. Not a single year should go by when you're not shifting money into the tax-free zone. If you miss this year, if you miss 2023 and doing Roth IRA conversions, it's your own fault. Because I've been telling you that you should not have a single year that goes by when you do not shift money into the tax-free zone. Don't miss this opportunity. Do it right now. And by the way, some of you may need a portfolio makeover because you had too much money in your taxable bucket and your tax-deferred bucket and not enough in your tax-free. So you can get in touch with me, again, in the description section below. I'll take a look at that and give you my opinion of what's going on. And then finally, always invest with a margin of safety cushion. In good markets, bad markets, and everything in between, your margin of safety will keep you not only safe, but it'll also give you peace of mind. And let me tell you, that's something we can all use. I'm Ron DeLegge with ETF Guide. I hope you've enjoyed today's episode. Hit the comment section below. Let me know what you thought, and we'll catch you on the next episode.